Welcome to Manager EDU. Today, I will teach you Profitability Index. This is a continuation of our series on capital budgeting techniques. I will teach you with an easy concept and example. Let's start. Let's take the same example we have used in IRR, NPV, and payback period. The Bitcoin mining project starts with an investment of $1,000 and continues for 5 years. It gives a return of year 1, $300, year 2, $400, year 3, $450, year 4, $350, and the final year, year 5, $370. First, we will calculate the present value of future cash flows. We create a table with columns for year, cash flow, discount factor at 10%, and present value of future cash flow. We write the series of years from year 1 to 5. The discount factor is applied at 10%. To learn how to calculate the discount factor, please watch my lecture on NPV. Then we multiply each discount factor by the cash flow for each year. The total present value of future cash flows is approximately $1,410. Now, the formula for the Profitability Index is present value of future cash flows divided by initial investment. In this example, after applying a 10% discount rate, the total present value of future cash flows is $1,410, and the initial investment is $1,000. So we calculate $1,410 divided by $1,000 equals 1.41. So the Profitability Index is 1.41. What does the Profitability Index mean? It means that if I invest $1 today, my total income after 5 years, after accounting for inflation, earning potential, and risk factors, will be $1.41. This is one of the easiest and most powerful technique in capital budgeting. Now, how should you accept or reject a project using the Profitability Index? If the Profitability Index is greater than 1, it is a profitable investment. If it is equal to 1, it is a break-even investment. If it is less than 1, it is not a profitable investment. I hope you understood this. If you have any queries, please comment below. Subscribe to my channel. Thanks for watching.